Welcome to the Deep Dive. Today we are jumping right into the really interesting story of Loop Industries.
Yeah.
We're looking at their Q3 fiscal 2026 corporate update call from January 15th.
And this one is, it's a special case. This isn't your classic earnings report deep dive.
No, not at all. This is a capital markets story.
Yeah.
It's about industrial execution. The call itself was this dramatic clash between these, huge strategic milestones they're hitting and then these headline financials that were, frankly, just jarring.
That's the perfect word for it. And so our mission today is to really unpack what matters here. It's not about the top line revenue. We're talking about contract structures, financing progress, and that all-important industrial build timeline. This is an execution equity, plain and simple.
Okay, let's start with those financials then, because you can't ignore them. They really set the stage for the market shock.
Absolutely. So let's just get it out there. The GAAP EPS was actually fine, in line at -6 cents. No surprises there.
But the revenue?
The revenue was a massive, massive miss. The company reported about $80,000.
80,000. And the consensus estimate was what, 875,000?
Exactly. It's a negative surprise of nearly 91%. Year over year, that's a drop of almost 97%. I mean, it's a jaw-dropping number.
And so you see that number and you think, okay, the stock must have just cratered.
Right.
But it only dipped about 3.5% on the day.
Right.
So why not a 20% bloodbath? What is the market seeing that headline number misses?
I think that's the real story here. The market is signaling that it's looking past this. First, the net loss actually improved a lot year over year. It went from nearly 12 million down to under 3 million. So good expense management.
Okay.
But the bigger picture is that investors already know this is a long-term financing and execution story. The stock price already bakes in huge dilution risk, huge execution risk. The market traded the miss, but it seems to have listened when management basically said, hey, stop looking at the income statement. The real value is in the contracts we just signed and the facilities we're about to build.
That makes a lot of sense. So they're selling the future, not the present. Okay, so let's do what management wanted us to do. Let's focus on the milestones, starting with the big one. The Infinite Loop India project.
The India project is everything. It's the anchor for the entire story. It's their first real proof of concept at industrial scale.
And the headline win here was obviously that multi-year offtake contract with Nike. This feels huge. Nike as an anchor customer.
It is huge. And it's not just the name. The most important part of that contract is the structure, specifically the take-or-pay element.
Unpack that. What does take-or-pay mean in this context, and why is it so important?
It's critical for what's called bankability. It means Nike contractually guarantees they will pay for an agreed-upon volume of resin, even if, for some reason, they don't actually take the physical delivery.
So it guarantees a revenue stream.
Exactly. If you're going to a bank asking for, a $130 million project debt package, the first thing they want to see is certainty of cash flow. A take-or-pay contract from a company like Nike basically de-risks that future revenue for the lenders. It makes the whole project exponentially more attractive to finance.
And on the build side of things, they also locked in Toyo Engineering India.
Yes, and that's the other key piece of the puzzle. Locking in Toyo moves the project from, a plan on a slide deck to a physical reality. They're handling the detailed engineering all the way through construction completion.
Which has a timeline.
A very important one. Q4 2027. That date is now the one to watch. The whole facility is targeting 70,000 metric tons of capacity, and they're aiming for 5 or 6 customers to contract all of it. With Nike and another company, Tyrell Plus, already secured, they're well on their way.
Okay, so that's India. But here's where it got really interesting for me. The European expansion?
Right, with Reed Societe Generale Group. This is the next phase, and it's all about cost and efficiency. They're targeting the same 70,000 ton capacity, and they've narrowed the site selection down from 20 sites to just 3.
And the lead site is in Germany.
The lead site is in Germany, and the really innovative part is how they plan to build it. They're going with a modular construction plan.
They made a pretty bold claim on this one. Something like a 50% reduction in CapEx versus a traditional build. How is that even possible? I mean, building in India and shipping it to Germany sounds expensive.
It sounds counterintuitive, but it's a brilliant strategy. It's about labor arbitrage and leveraging existing infrastructure. So first, yes, you prefabricate the massive Lego blocks of the plant in a lower cost labor environment like India. That shifts a huge amount of expensive on-the-ground construction work from Germany to a more efficient factory setting.
Okay, that part makes sense. But the shipping costs must be huge.
They are, but this is the second part of the genius. They are specifically targeting existing chemical plant sites because the utilities are already there. Think about it. If you build a new plant from scratch, you have to spend a fortune on steam generation, cooling towers, nitrogen lines, all of it. By plugging into an existing site, all that expensive infrastructure is already in place. That savings more than offsets the cost of shipping the modules over. It's a huge de-risking of the project's capital costs.
That is clever. So we're looking at two massive projects, 140,000 tons of capacity, both aiming for late 2027. Which brings us right back to the money. How much cash do they have, and how are they going to fund all of this?
And that is the tension, isn't it? At the end of the quarter, they had $7.7 million in available liquidity.
That sounds very thin.
It is a thin runway. Now, to their credit, their cash operating expenses were down to $2.2 million, a good drop from the year before. But, compared to the capital needed, it's not a lot.
So what are the specifics on the India financing? They laid out the structure.
They did. They confirmed they're seeking a $130 million project debt package. That's about 70% of the total project cost.
Okay, so Loop's share, their equity contribution, is the other 30%.
Roughly, yeah. It comes out to about $28 million.
And that right there, that $28 million equity gap, plus closing the $130 million in debt, that's the whole ballgame. Right. That's the execution risk the market is so worried about, right?
That is 100% the reason for the stock's discount. And management knows it. They brought in a new CFO, Spencer Hart, who officially started on the day of the call. His entire job is capital markets, raising this financing.
And they gave some color on the debt side, who they're talking to.
They did, and this is a really important detail. They said they've received term sheets for the debt from multilateral development banks, sovereign wealth funds, and international commercial banks.
So it's not just regular banks. What does it signal when you have development banks and sovereign funds involved?
It signals a level of strategic validation. These institutions often have mandates that go beyond pure profit. They look at ESG impact, strategic national importance, things like solving a massive textile waste problem.
So they might accept a longer payback period or a different risk profile than a purely commercial bank would.
Exactly. It suggests the project is seen as strategically important, which really helps the de-risking narrative. Even with a tight corporate balance sheet, it's a huge vote of confidence.
Okay, that makes sense. So let's shift to the why. Why would any of these investors take on this risk? It all comes down to their core technology, Twist.
Precisely. The whole thesis rests on the technology and the market it serves. The textile-to-textile market is the real prize here. Global PAT and polyester production is, 85 million tons a year, and 2/3 of that is textiles. It's just a colossal underserved market.
A market that's also about to get hit with a regulatory wave in Europe.
A regulatory tsunami, yeah. The EU has had separate textile collection requirements since January 2025, but the real enforcement hammer comes down in 2028.
Which times perfectly with their plant completion in Q4 2027.
It's perfect timing. For apparel companies, this is no longer a nice-to-have sustainability project. It's a must-have regulatory mandate. They need a solution for their textile waste, or they're going to face massive fines.
And Loop's tech is uniquely suited for this because post-consumer textile waste is just a mess. It's not clean plastic.
It's an absolute mess. It's polyester mixed with cotton, nylon zippers, buttons, dyes, you name it. Typical high-heat recycling just can't handle that level of contamination. It ruins the final product.
So how does Loop's low-temperature process, the methanolysis, get around that?
Well, the low temperature is key. It allows them to chemically break down just the polyester into its basic building blocks without destroying everything else in the mix. The cotton, the nylon, the metal from a zipper, they all remain physically intact.
So they can just filter out the junk.
Yeah, they can literally filter out the junk, leaving them with a pure chemical stream that they can turn back into virgin-grade resin. That ability to handle a really dirty, complex feedstock is their competitive moat. It's why they can do high-quality textile-to-textile recycling when others can't.
And because it's a unique process for a mandated problem, they get a price premium.
A significant premium over the packaging market right now, yes. And they're smart about it. They're built to be agnostic, so they can sell into whichever market, textile or packaging, offers the best margins at the time.
Okay, so let's tie this all together. The near-term story is all execution. The stock is going to live or die based on a few key catalysts.
4 cluster catalysts is how I see it. 1, closing that $130 million debt syndication. 2, signing up a few more offtake customers to fully contract that India plant.
Right.
3, finalizing that European site in Germany. And 4, the big one, hitting that Q4 2027 construction timeline. Any slip up on those, and the risk profile shoots right back up.
All right, let's shift gears to our final segment. And we have to stress, this is not financial advice. We are not registered financial advisors. This is just a high-risk, high-reward strategic idea for you to think about. Please, do your own due diligence.
This is the outrageous but plausible trade.
Let's hear it.
The thesis is simple. The market is pricing Loop like a pre-revenue science project R&D company. It's applying a massive discount because the capital isn't fully in place for the India plant yet.
But, as we've discussed, a lot of de-risking has already happened. They have Nike, they have Toyo, they have term sheets from sovereign funds.
Exactly. And remember, that India plant is projected to have a payback period of less than 3 years once it's running. These are incredibly valuable assets, suppressed only by the funding risk. The bet is on funding certainty.
So the market re-rates the stock the second the financing is officially closed.
Instantaneously. The perception will shift from maybe it gets built to it is imminent. So the trade is to take a highly leveraged, long-dated position. Think long-term call options, or maybe a small, aggressive equity stake, timed to mature just before that Q4 2027 completion date.
So you're essentially buying a discounted industrial asset with government-backed demand, and you're betting that the closing of that $158 million capital package will be the catalyst that closes the valuation gap almost overnight.
That's the trade. The leverage on that financing catalyst is enormous. If they pull it off, the re-rating should be significant. If they fail, of course, the bet goes to zero. It is a pure binary bet on execution.
A very sharp high-stakes trade. Okay, to wrap up, the tension here is clear. The financials are thin, liquidity is a real concern, but the industrial progress in India and Europe, with names like Nike and Toyo attached, is tangible and moving forward.
And I'll leave you with one final thought to mull over. The CEO mentioned on the call that the amount of textile waste available just in India is over 500,000 metric tons a year. Their total planned capacity across both new plants is only 140,000 tons. So if they can prove this model works in India, you have to ask yourself, what is the true scale of this opportunity, and does the current valuation reflect that runway at all?
An intriguing thought on the sheer scale of the market. Thanks for joining us for this deep dive. As always, you've heard the analysis. Now go do your own due diligence.